Hey guys, welcome back. My name's Aaron. This is Czar Finance, episode 14, Investing 101, Knowing Thyself. So when it comes to knowing thyself, from the Greek philosopher Socrates, he's basically referring to getting in touch with your inner self, knowing who you are and where you stand, and understanding when it comes to investing, what is your risk to reward ratio going to be? It varies between every single person on this planet, okay? It varies between everybody, whether you're young, whether you're older. Now, what happens is you have to know if you are in the older ages or stages of your life, say you're beyond 55 or so, considered old. That's not really considered old, it's all a mind state. But if you're considered an upper age, your risk is going to be slightly diminished because you don't want to have volatility in the market or be able to put a lot of money in the market, and if the market drops for whatever reason, your risk for reward is not going to be so good. So you want to lower your tolerances for that risk because you're going to retire pretty soon, and or decide to save some money for, I guess, for retirement basically, and decide what you want to do with it, whether you want to buy a fancy car or buy a big house or just relax or travel or do something with that money. So your risk to reward ratio is going to be slightly smaller. So you want to be very conservative when it comes to your money at an older age. You want to in slow growth stocks, bonds, things like that, things that will not move as much and conserve your money. So that's one way of looking at it. The other way of looking at it too is to think as if you are, and you have, if you are young in age, maybe in high school, middle school, and you're starting to build up an inventory or build up some money and supplies and savings that we've talked about, you have time on your side, which means you have a greater chance to take risks. So if you happen to, spend $100 on something and then you lose it, well, you have time to earn that $100 back at another time, whether it's working at another job or whatever. But you have the flexibility to have the time on your side, basically. So it's a time management issue when it comes to investing. Now, another thing to think about too is what is your financial position in life? Some people have a lot of money, some people have no money. And when it comes to having a lot of money, say someone's a multimillionaire, well, they can afford to put $100,000 down on an investment, whether it's a stock, bond, mutual fund, or a startup company or something, and know that they can lose that money and not have to worry about it. It's not going to really make a huge dent in their portfolio or in their salary. It's not going to, it's not going to really bother them. Whereas someone who's like a newbie in the market, who's just starting out to save, doesn't have the type of money, and they look at like, wow, $100,000, that's a lot of money. And so in order for them to get up to that level, they look at a $100 value and say, that's a lot of money to me. So I'm going to put that down, and I'm going to be more cautious with that $100 because I don't want to lose it. So it all comes down to risk to reward ratio, and whether you have time on your side or if there's not enough time on your side to find out what you're willing to lose. And that's what it comes down to, knowing thyself. Know what your risk to reward ratio is. You need to make sure that you have the ability to lose the money should you put money down. Because when it comes to investing, although everybody wants to make money with it, sometimes there's some disappointments, and we're going to get into that into our next episode about what happens if that money happens to go down or go south or lose money from your investments that you've decided to invest in and then it goes down. You have to be able to take that money and in hopes that it's going to make money, but knowing that you will survive without it. It's sort of like just take $100 and put it to the side and say, well, I hope it does well, but if it loses or disappears on me, that you can survive and move forward with that. So that's what is the reward to risk ratio, and knowing that you have the ability to lose that risk should it go south on you. If you want to start in trading and investing, the great way that I learned is to basically get yourself involved with like an online account, say like TD Ameritrade or Fidelity, or there's a whole bunch of different sites out there that offer free online trading with paper money or virtual money. They often start you off with a $100,000 bank account that's virtual, and it's a great way to learn to paper trade in the stock market, mutual funds, bonds, things like that, and you don't have to lose anything. And what you're doing at the same time is you're building up your skill sets, you're building up your knowledge base on how the market, are you looking at stats of a company, are you looking at the bar charts, are you doing things like that, and refining your skills so that when you do take real money and you feel confident, or have a better confidence that your money will grow from $100 to maybe $1,000, from $1,000 to $2,000, from $2,000 to $20,000, from $20,000 to $100,000, etc. And you feel a little bit more confident. So in time, if you have more time on you, I advise you to experiment and play with the paper money or virtual money templates that are out there, different ways to do that, and get to know yourself, know what is your risk. And the way I started again too is by doing that, but I did it, although they gave me $100,000, I pretended I only had maybe $1,000 to play with. And I used that because that's what I really had, but I'm only going to play with virtual money. So I took that virtual money of $1,000 and I said, oh, I'm going to spend maybe $100 on this company. I'm going to spend $100 on this company and that company. And I divided my portfolio of maybe 10 stocks of $100 each for $1,000. And I watched it to see how it grew and how it went down, or did I do this thing the right way? Did I not do it the right way, or sell it? And see, did I take that virtual $1,000 and was I able to grow it to maybe $2,000? If I did that a couple times and I felt confident on it, then it was time for me to take my real earned money that I had, and I was nervous. The very first time you get nervous, you're like, oh man, this is the real deal, here we go. You take that and you actually invest it with the company, whether it's Fidelity, TD Ameritrade, or many other investment opportunities you have, and then you start playing with that with just a low amount. Do not go full bore and put all your eggs in one basket. Start off small. That's how you learn. Start off with $100, if anything. Just do $100, or $25. Buy a couple shares of something. Keep track of it. Watch it where it goes. And then from there, if you're making money with it, pocket it, keep it on the side, and don't get greedy. The biggest thing is do not get greedy. Know thyself. And know that you can afford to lose it, but don't get greedy saying, oh, I'm going to put everything now back into it, or I'm going to put this back into it, because it can go up and down, and if it goes down, you're going to have an attachment of mood swings, and you're going to have this emotional battle with yourself, and it's very concerning because it can wreck some people's lives, and they get emotionally attached to their money. You got to be disattached from your money and know that you can lose it if it goes south or it doesn't go the direction you choose to. So my advice to you today is to know thyself. Understand where what your risk to reward ratio, find out what your time span is. Are you younger or are you older? Are you going to be more conservative or more risky? And start small, learn the basics, practice with virtual money, and in time, you'll be a great investor. Take care. My name's Aaron. This is Czar Finance, episode 14, Investing 101, Knowing Thyself. And on next week's episode, we're going to talk about the disappointments in investing and some things to look out for and to expect when the markets go up and down. Take care.